Hey everyone, Lawrence Mak here, real estate broker out of Mississauga. I'm pleased to be joined again by Chris Mulder from Tridac Mortgages. Hey Chris.
Hey, Lawrence, nice to see you again. Thanks for having me.
Yeah, no problem. Nice to have you here. Today we wanted to talk about getting a mortgage when you're self-employed. This seems to be an issue for some of my clients when they're looking for a place. And depending on the qualification, just wanted to go right to the source and ask Chris, like, what's going on? You know, if you're self-employed, what is it that we need that's different than a regular employee?
Yeah, good question, Lawrence. There are certain challenges around qualifying self-employed borrowers, and really the focus of qualification is on trying to determine what is because there are two numbers when you're self-employed. There's what your actual income is. If we were having a drink at a bar, you know, post-COVID, we might have a conversation about what your income actually is. And then there's another number that you show to Revenue Canada. And those numbers are different, okay? So mortgage lenders treat it the same way. And there's really a fork in the road when it comes to qualification for self-employed borrowers. The starting place is to determine what your personal taxable income is.
Mhm.
So a mortgage lender will focus on what's called line 150 of your tax returns. So they'll look over a 2-year period to average it out over the last 24 months. And based on that taxable income, they will qualify you on that number.
And the line 50 again is the gross amount that comes in before
Gross
RSP?
that's gross taxable personal income.
Right.
So that is the number that you will pay income tax on as an individual.
Got it. So look at line 150 on your return. Okay.
That's right. That's right. But that line 150, if you're self-employed, represents your income after write-offs.
Right.
So for most people who are self-employed, actually for all people who are self-employed, that net number that you pay taxes on is significantly less than what your true take-home income might actually be.
Mhm.
And so then the focus turns to what the actual income is of your business. And of course, businesses can operate many different ways. You could be a sole proprietorship or operating as a sole proprietor. You could be an independent contractor, which is like being a sole proprietor. You're basically business for self and have to do your own deductions. And you can also run income through a corporation, right? And so then the focus of the application will turn to that gross revenue amount. So when you're self-employed as a sole proprietor, that's captured in your statement of business activities. Or if you're commissioned, in your statement of commissions, right? Also, sole proprietors will have it on statement of business activities as well. So you'll have top line, your revenue, and then with your accountant, they'll do all the deductions, home office, your vehicle, etc. There will be a net number, which then translates into your personal taxable income. And mortgage lenders, when looking at that, understand that individuals who are self-employed write off a lot of their personal expenses. So there's a method where we gross up a portion of the income to capture some of those write-offs. Okay. If it's through a corporation, then the structure is very different. So with a corporation, you may pay yourself as a salaried employee, so you may be T4ing yourself. The other method is to pay yourself a dividend from the retained earnings at the end of the year. So there are many different ways that you can pay yourself. Okay. So at this point now we have to figure out what is actually showing, because if we break the market into two major buckets, bucket A and bucket B, A lenders will focus on that line 150 number or something close to it. You know, we really have to demonstrate in your tax returns that you're earning the income. And the A lenders will focus on that. And the benefit of working with an A lender is that you get the best rate, best terms and conditions, no additional lender fees. And that's where most people want to be. But most self-employed people don't want to show the income. They want to save money in taxes, right? So they may not show a very strong number. In that case, we then have to focus the conversation on what the cash flow is, and demonstrate that to lender. And only B type lenders, what we would quantify as B lenders, would be willing to be that pragmatic in their approach to considering your self-employed income.
Okay, so you're talking about grossing up for the self-employed people. How exactly does that work, or what? I guess how much more could I get from my stated gross income?
Right. So it's typically 15%. So if your line 150 is $100,000, then the lender will allow us to gross up $15,000 of the line 150. So you could potentially confirm to the lender that your income is 150.
Okay, so just a little bit more, but
yeah,
I mean, 15% could be good.
Yeah, it can push the boundary a little bit, but again, most self-employed individuals don't want to show that income,
right.
So it's very, very challenging. And so it's an interesting conversation, because on the one side, you either pay taxes and qualify for a low interest rate, or you get more efficient with your taxes. Not that you're doing anything illegal or untoward, but you're more efficient with your taxes, so you lower your marginal tax rate, but you have to pay a higher interest rate, right? And so there's a trade-off. And of course, everybody that I talk to obviously wants the lowest interest rate. But when you consider that you can be self-employed, save money in taxes, and yes, you have to pay a little bit higher in interest rate, the offset of that makes it better and more efficient for you to actually take a mortgage with a B lender, right? So the higher interest rate, yeah, you pay more overall, but it's much cheaper than what it would cost to pay taxes on $150,000 of income or $200,000 of income, right?
Yeah, no, that makes sense. So going back to the corporation then, basically if the corporation pays out just a T4, do the banks just treat that as a regular salaried employee at that point?
Yes, they would, but because it's not arm's length, you would have to be self-employed this way for at least 2 years, so that the bank can average it out.
Now, would the bank take into consideration the health of the corporation?
They would, yeah. So if we can produce strong business statements, business financials showing retained earnings, because a lot of small businesses, it's a hobby, right? Money flows through. There may not be much in terms of retained earnings. But if we can demonstrate consistent retained earnings and you are a 100% shareholder, then the bank will consider that as additional income, yes.
Okay, so that would be favorable as well. And how do spouses factor in this?
Yeah, so the spouse, are you talking about income splitting?
No, more like if you're like a self-employed person, but maybe your spouse has a job somewhere. Like, are they considered from a bank point of view like two separate entities, and you add up the amount of mortgage room?
That's right.
That roughly how it works?
That's right. Yeah. So if your spouse is working a salaried position, then that salary would be used 100% business as usual. For salaried individuals, it's much easier. All we need is a letter of employment and pay stub to confirm income. So that income would be separate. Then there's the self-employed income. You add it together to get your household income.
I see. And are there any type of other advantages, either from employment or from a corporation point of view, that can help in terms of making the numbers look better?
The numbers are what the numbers are. The lenders, in general, mortgage lenders do not take anybody's word for anything. You need to show all the statements and everything. So it's hard, but there are other types of income that can be added to an application. Rental income, if there's a rental property. One big one that a lot of borrowers will take advantage of is Canada Child Benefits. So the CCB payments can be added to the overall household income as well, which is really convenient.
So if you had the situation, maybe a corporation lends you money or something like that, does the bank look at that more or less favorably, or it doesn't really matter where that particular money came from, or you don't know?
Yeah, if they're lending you money, then that's not income, right? because it needs to be returned. So income really is from income producing activities.
Okay.
And so it's either a salary paid or a dividend if it's flowing through a corporation.
And you mentioned before that the banks probably look at the last 2 years. Do they go any further than that, or basically it's 2 years, like pretty much all the time? Is that like 90%
Yeah.
of the time that's the case?
Yeah, it's almost exclusively 100% of the time that they'll use the most recent 2 years.
Hmm.
If there is some extreme circumstance that is affecting numbers, they might consider three. And I think in the context of 2020 and the pandemic,
Yeah.
many businesses were affected. And so it'll be interesting to see in 2021 and even beyond, because it's going to really be in beyond 2021, that lenders may be a little bit more flexible with it and say, okay, we understand this was an outlier year. Show us pre-pandemic what your income looked like. So that is a moving target yet to be determined.
So that depends on each different financial institution?
Yes, yeah. But in general, the guidelines of the lender are always most recent 2 years.
Most recent 2 years. But again, we don't know how it's going to go with 2020. So if it's like
Yeah,
someone makes 200,000, and then like 100,000, like we don't know, or you have to pretty much go back 3 years and see what they say.
that's right. Yeah, I think they would consider the strength of 2018 and 2019.
Hmm.
One other comment to make about 2-year averages is that if your most recent year is lower than the previous year, then the lender will use the lower 2-year average if it's increasing, but if the
Ah,
trend is downward, they just use the lower amount.
so in this case, if they went 200,000, 200,000, 100,000, it would just be 100,000.
Correct.
And then
Yes.
you'd have to make some case and then they'd probably reject it. Is that roughly what would happen?
Yeah, you make some case, but for example, if 2020 was an outlier, they would ask us to support that, give some argument that 2021 you're back on track to do as
Right.
well as you had done pre-pandemic.
So
So
sometimes
bank
then,
statements, invoices, that kind of thing. Yeah.
so sometimes then you can always make a case, I guess, that the existing trend is good. I mean, not even just 2020, but any year really, that
Yeah.
everything looks good. And so here's the receivables, here's the whatever. And so then they'll have to make a case by case basis.
Correct. Yeah. So yeah, they would focus on, typically they would ask for maybe 6 months of bank statements for the
Hmm.
business. And we would have to demonstrate that there's regular revenue coming in as per the income that we're reporting or claiming that you earn.
So what happens then if the corporation is very new in this case? Let's just say 3 months, 6 months, you don't have 2 years of
Yeah.
financial statements.
Yeah.
What do they do? Or do you have to wait
Yeah.
2 years?
And I mean, it's difficult. So that's where we turn to the B option,
Hmm.
and B lenders will be a little bit more practical with it. Typically, they would like to see at least 6 months of banking information for your business to demonstrate that you are earning the income, and we can project forward with them,
Hmm.
earning the income that you claim you are earning in the application.
Okay, so basically it sounds like a lot of A lenders have certain rules and formulas they're trying to follow. And the B lenders just really looking for some profitability, I guess. And so they can make that assessment on a case by case basis on whether or not
That's
you're a good
correct.
credit risk.
That's exactly it. And they consider the overall picture. If it's a new corporation, for example, 3 months, what were you doing previously? Is
Hmm.
it the same line of business? Were you switching from sole proprietor to new corporation? Common things are people who are in IT, right?
Right?
If you're in the IT industry, very often you can go from salaried IT to independent contractor IT. If you're a contractor in construction, you could switch, between being sole proprietor into a corporation at a certain point. Very common. Or realtors now.
Yeah, for sure. Now that realtors can incorporate. So then
Yeah.
did the banks look at the net worth of the person who's borrowing, or do they not care and they're just trying to figure out how much to lend you?
Generally, no. Net worth is not a major consideration. The main consideration from a bank's point of view is debt servicing. They want you to demonstrate that you have the income coming in to support the payment obligations that you have in your life. So that's mortgage payment, property taxes, condo fees if applicable, and then servicing your other debts.
Right. So they don't care you have $1 million cash in the bank. your question to me is that, you want to borrow a mortgage of $500,000. And I'm trying to figure out how to justify that using the salary. Is that right?
That's correct. That's where the focus is. Having said that, though, there are some lenders and banks that have specialty net worth programs
Mm-hmm.
where if we can demonstrate certain thresholds, you can qualify for a mortgage based solely on net worth, or I shouldn't say solely, in part with net worth. You still have to have income coming in, but the net worth can help to mitigate. But that is not common and it's not widely spread in the industry. It's a very niche product.
Okay. I guess it'd have to be a somewhat high net worth individual or family.
Yeah, definitely. Yeah. The minimum is you need to have at least $250,000 liquid
Mm-hmm.
in order to be considered.
Okay. Well, I think that's all the questions I have here. Do you have anything else that you can add, or is that pretty much everything you got?
No, I mean, when it comes to self-employed, it can be a little, to navigate through the questions can be a little bit challenging. And so for anybody who is self-employed or wondering what their application will look like, I would invite them to get in touch with myself or any mortgage broker who can guide them through that conversation.
Yeah, it sounds like it has to be done on a case-by-case basis, because depending on the corporation or sole proprietorship or partnership, everything is a little bit different. And so you need somebody like yourself to look through all the numbers and just get a better sense on how to help.
That's exactly it. The door is always open to anybody. And I'm sure we'll include a phone number here, email address up there, website over here.
So Chris, what's the best way for people to reach you?
So you can find me at Tridac Mortgage. That's my website. My cell phone number, 416-732-8020. Call with confidence. I'm always here.
Yeah, sounds great. So if you guys have any questions about mortgages or you're self-employed and just need to pick his brain, just give Chris a call. And again, I'm Lawrence Mak, real estate broker out of Mississauga. See you later.
Bye, Lawrence.
All right, bye.